This podcast is intended for investment professionals only.
Hello and welcome to this episode of Market Talk. In a month which is always associated with the old stock market adage, sell in May and go away, we'll be asking, does recent US data make recession worries redundant? What's last week's big move in US Treasuries telling us? And why have US tech stocks put in such a good performance year to date, but their Chinese counterparts are still in the doldrums? So asking the questions here in the UK is me, Frances Watson, and providing us with all the answers, Ben Bennett, who joins us from Hong Kong. Ben, hello to you. It feels a little bit quiet at markets at the moment. It can't all be the fact that everyone's at the Chelsea Flower Show today, which is starting today, but investor pessimism seems a bit flat on the floor. Should we start by chatting through what we do know, which was some of last week's data? And we got stronger than expected US data, in particular retail sales and industrial production.
Yep, we've actually had okay data in the US for a little while now. The Q1 GDP, remember, came in positive, and Q2 GDP, I mean, we think it's sort of flatlining. It's going to sort of come in at zero. But if you're tracking the data, like you say, the retail sales, industrial production, some other data as well, it looks as though there's going to be a small positive as well in the US in the second quarter, still early days. But that's, better than feared at the beginning of the year, and it's still doing okay. But to be fair to our economics team, it's still pretty much in line with what they're thinking. I mean, small positive is not that much better than flatlining. We're thinking that the recession happens in the second half of the year when the consumer has run down their savings. They're rapidly running down their savings, which is the reason why retail sales are fine. Industrial production is fine, but not particularly strong. We know that goods demand has waned since the COVID. Since everyone's come back from COVID and going to restaurants instead of buying stuff. So that's going down. Auto manufacturing is doing pretty good, but generally goods manufacturing, industrial production is not doing very well, but the data was better than expected. But it's not too bad. But that contrasts to China, which we've seen, disappointing data from a really nice start to the year, nice rebound in January, February as they reopened. Lots of pent-up demand for stuff, but that demand seems to have been spent, and people are staring the reality in the face in China that there isn't as much support from governments. There's not fiscal handouts like we've seen in the West, and the data recently has been disappointing in China. So I'd say better than expected in Europe and US, but not brilliant, but definitely disappointing in China.
And let's just stick with China at the moment, because of course we've wrapped up the G7 meeting in Hiroshima over the weekend, haven't we? But there was a really strong condemnation of China on a lot of fronts. What implications has that got for investors then, Ben?
Well, I don't know if it's massive implication. We know the G7, the group, those 7 countries are basically all allies and are sort of putting up a united front to try and rebuff some of the stuff that China's doing. But it's not necessarily the best reflection of global sentiment towards China. I think you've got to wait for the G20, which involves a lot more countries, which have a more, differentiated balance, however you want to frame it, viewpoint with China. That the next G20 leaders summit is going to be in India in 9th and 10th of September. So we've got a little while to go for that. But the G7 generally says all this sort of stuff, and it is important. Of course it is, because the policies that those countries have are key. G20 a little bit more differentiated. But it's interesting that, we're talking here on Monday, the 22nd of May, and actually Chinese markets are rallying. The Hang Seng here in Hong Kong is doing pretty well today. President Biden said that there are going to be, we should expect US-China relations to improve very shortly. It's a little bit ambiguous. I don't know exactly
I read that. And and I didn't know quite what to make of it. But obviously markets, again, have latched onto the positive, haven't they?
Yeah, absolutely. Yeah, that seems to be the way at the minute.
And of course, staying with emerging markets, in Turkey, they haven't been so positive. I think we've had quite heavy falls there, currency-wise, markets-wise. But Erdogan looks set to continue as president.
Yeah, there's the second round election, the sort of runoff next weekends. He's the favourite to win that second election, having done much better in the first round. And markets are taking it negatively just because Erdogan has implemented some pretty unorthodox policy, shall we say. So whereas everyone else, when inflation goes up, every central bank tightens policy, so hikes interest rates in order to get demand down and therefore prices down ultimately. Turkey seems to do it differently under this regime, where they would actually cut interest rates and loosen policy with higher inflation to try. And I'm not exactly sure the reason why, but that's the policy, and it does lead generally to a weaker currency. We've seen that over the years, and we've seen that as a reaction to the results of the election. There was some chance that would have a new regime in charge, and maybe they would change to something more orthodox. But like I said, that's looking unlikely. But who knows with elections these days? They're hard to call, aren't they?
Yeah, so status quo for the minute. Okay, so let's look at the here and now and what markets we think are telling us. Last week, I just want to pick up on the big move in the US short-dated treasuries and the stronger dollar. What's that telling us about markets in their current state then, Ben?
Well, yeah, so it was only back on, I was looking today at the 2-year Treasury yield. On the 4th of May, it closed at 3.8%, just under actually 3.8%. And then it closed on Friday, the 19th of May, it closed at about 4.3%. So up, half a percent. And a lot of that was last week, as you say. I think what's going on here is all to do with the debt ceiling. So this was hot topic a couple of weeks ago. People worried about the potential that we'll have a big accident. Also, the regional bank, the sort of second round of the regional bank crisis flared up at the same sort of time. So there was a chance being priced into markets that we'd have a pretty aggressive rate cutting cycle, maybe as early as July. That was really a reflection of, look, if things really go bad, then the Fed is going to have to potentially cut because we're going to be in a deep recession. It was no one's base case, but even if that was a 10, 15, 20% chance, and you factor in a big rate cutting cycle of 20% chance, then that leads to swings of 20, 30 basis points in the average rate. That over the last week or so, has that downside risk has started to ebb away somewhat. Yeah, the regional banks have got calmer again, and they could flare up. I suspect this is not the end of the line there. That's actually what reportedly Janet Yellen has been saying to CEOs of big American banks, that expect maybe even more mergers. So that's not gone away, but it's gone down a little in terms of risk. And then the debt ceiling negotiations up until Friday were looking quite harmonious, when everyone was sort of chatting, we're going to get a deal, don't worry. It turned a little bit uglier over the weekend. President Biden has flown back early from his Asian trip. He just did the G7. He was meant to go to Australia and Papua New Guinea as well, but he's gone back to the US. He's going to be talking with the Republicans, hopefully get something done, because the clock is ticking. Janet Yellen says that they could run out of money as early as the 1st of June. It's more likely to be the middle of June if something bad does happen. But we've only got a couple of weeks left, and the two sides are quite far apart apparently still. Republicans want big spending cuts, and the Democrats don't. So it's pretty fundamental.
And I'm just thinking, and I don't know if there's any way we can put that all together in terms of rotational styles in markets at the moment, because of course what we've seen year to date is this big rise in US growth stocks, for want of a better word. I don't know, does that tie in with?
Yeah, I think partly. So one of the big reasons why the technology stocks of the big sort of FAANG index was so poor last year was when interest rates were going up. There was this concern that, these long dated cash flows from these growth stocks, if you increase interest rates, then all of a sudden the value of them today goes down. And they had a terrible year last year. So interest rates broadly have stopped going up this year. I mean, they haven't gone down much, but they haven't gone up. They're sort of peaked back in October last year, if you look at the 10-year Treasury, for example. So that lack of increase in yields was a bit of a relief. So that's one thing. And then the other thing, which I've seen plenty of stuff written about, I'm not sure exactly what the numbers are behind it, but this sort of the focus on artificial intelligence, this sort of chat GPT stuff. And there's been more focus on companies, big companies, small companies, with the ability to monetize this new trend, and money's been flowing into that. And I've even seen some reports saying that AI flow, that AI performance is basically behind the entirety of the technology stocks outperformance. So whatever the truth is, probably not quite as big as that, but that's definitely helped as well. So those two things have really helped the rebound.
So really specific factors there rather than maybe interest rate trends possibly. So should we just talk about what's happening this week ahead? I mean, we've got some flash European PMI sentiment surveys in Europe. Not sure again about the state of the European economy. Perhaps those will tell us how that's doing.
Yeah. So Europe, again, it's a bit like the US has done a bit better than expected at the start of the year. I mean, remember that was broadly because we were worried about gas prices or gas being cut off. Again, it wasn't necessarily a base case, but a reasonably high probability that would happen meant that growth forecasts were quite low. That has gone away, so it's been a bit of a positive. And yeah, again, Germany, UK, I'd say it's pretty much stagnating. It's not exactly booming, is it? We've seen a few GDP figures across Europe that have been pretty close to zero, frankly. So it's not booming, but not what would be technically called, I guess, a recession. But we still think that there's a recession coming, not only in the US in the second half of the year, but also in Europe. Maybe more likely to be a little bit later than the US, perhaps, because the US consumers look as though they're going to run out of money first, would be the concern. So maybe Europe will lag a little bit, but still, we think there'll be a recession at some point in the second half of this year, if not the first half of next year. And those PMIs will probably not give us too much of information for that, but they'll tell us that things are going okay for now. But we worry looking forward.
Yeah, I tell you, based on the cost of my weekly shop last week, the purse strings are being severely tightened in the Watson household. Okay, well, from purse strings to numbers, and tell us your number of the week, Ben, and why.
I was at a conference last week in mainland China. We went to an HSBC conference, which was very interesting. We're talking about long-term growth for China. We're talking about the property sector, and lots of interesting numbers were coming up. I also spoke to one of the real experts on China Autonomous, which is a research company, and the numbers are just extraordinary. So one number I'm going to sort of give you, 8 billion. So 8 billion is the number of square meters of Chinese sold but unfinished property. So that's property that has been sold to people who bought it, but they're still yet to complete it. 8 billion square meters. Well, there's 1.4 billion people in China, roughly. So doing my sort of rough maths, it's about 6 square meters per man, woman, and child that has been sold but has yet to be unfinished. That's quite a lot of property, isn't it? That's sort of sitting there.
How many football pitches is that?
Yeah, I was trying to think of a country that size, but I don't know. I didn't manage to come up with it. It's a lot, let's say. So it's a decent number of football pitches. But yeah, that tells you, I think, the sort of stuff that's going on in terms of overbuilt, because all these people currently live somewhere. And there's lots of people with second properties as well. And then there's this on the side. And they are hoping now to revitalise the property sector and build even more. Looking ahead, China is really going to have to focus on shifting from an investment-dominated philosophy into consumption, trying to boost the household, maybe reduce the power of these sort of investment companies, the local governments, the property companies, and boost the spending power of the household. It's a 10-year project. It's not something that's going to be worked out overnight, of course, but it just shows you the numbers involved are huge.
That sounds like an awful lot of debt wrapped up in that one.
Absolutely, yeah.
Yeah. Well, talking of wrapping up, we must wrap up. But Ben, thank you so much for your insights today, and thank you all for listening. Thank you.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers.
This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.